Most people think the estimated tax penalty is about guessing this year's income correctly. It isn't. The tax code gives you a second target based on last year's return, and if you hit it, the penalty cannot apply no matter how much you end up owing in April. That target is called a safe harbor, and in the next 6 minutes I'll show you exactly how to calculate yours, when to pay it, and what it costs if you skip it. The United States runs a pay-as-you-go tax system. The tax on income you earn in March is due in April of that same year, not the following April when you file. If you're an employee, your withholding handles this automatically and you never think about it. But if you're self-employed, taking retirement distributions, or realizing investment gains, nobody is withholding for you, and the Internal Revenue Service charges interest on whatever arrived late. Section 6654 gives you two independent tests, and satisfying either one shuts the penalty off completely. The first is 90% of the tax you'll actually owe this year, which requires forecasting a year that hasn't happened yet. The second is 100% of the tax on last year's return, a number already printed on a form in your filing cabinet. For anyone whose income moves around, the second test is the one to use. 5 numbers do all the work here. 90% is the current year test. 100% of last year's tax is the prior year test, rising to 110% if your prior year adjusted gross income was above $150,000. $1,000 is the floor. Less than that after withholding and the rule never engages. And 7% is what the underpayment charge costs you right now, compounded daily. The test is mechanical and takes about 30 seconds. Pull last year's Form 1040 and look at line 11, your adjusted gross income. If that number is $150,000 or less, your safe harbor is 100% of last year's total tax, which is line 24. If it's above $150,000, multiply that same line by 110% instead. Married filing separately uses $75,000 as the threshold. 4 dates, and notice that the periods behind them are not equal. April 15th covers the first 3 months. June 15th covers only April and May, a 2-month period that regularly catches people out because they budget a full quarter for it. September 15th covers June through August, and January 15th of the following year closes out the last 4 months. Miss a date and interest starts running on that installment from that day forward. Here's what that looks like with real dollars. This couple had $172,000 of adjusted gross income last year and $18,400 of total tax, so the higher income rule applies and their prior year target is 110% of that, $20,240. Their consulting income doubles this year and they'll owe about $31,000. 90% of that would be $27,900, but they get to use the smaller of the two tests. This is the part worth understanding clearly. The safe harbor doesn't reduce anybody's tax. This couple owes $31,000 either way. What it does is buy the legal right to pay the remaining $10,760 in April without any interest charge at all. Skip the quarterly payments and the identical tax bill arrives with about $778 of interest attached, because that money was legally due starting in April of the prior year. 3 steps, done once in January, and then you don't think about it again. Pull last year's return and read 2 lines. Line 11 for adjusted gross income, line 24 for total tax. Multiply the total tax by 100 or 110%, depending on which side of the threshold that adjusted gross income fell. Subtract whatever you expect to have withheld this year, divide the remainder by 4, and that's your quarterly payment. This is the single most useful thing in the whole topic, and almost nobody knows it. The tax code treats withholding as if it were paid in equal parts across all 4 payment periods, regardless of when it was actually withheld. So if you're short in November, you can raise withholding on your remaining paychecks, or have tax withheld from a retirement distribution. The code treats that money as though it arrived back in April. An estimated payment the same day gets no such treatment. How you actually deliver the money depends on your situation. If you have a W-2 job plus side income, adjusting your W-4 is far easier than remembering 4 vouchers, and the even treatment rule works in your favor. If you own an S corporation, you have both levers, payroll withholding on your salary and estimated payments against your distributions. And if you're retired or living on investments, ask the custodian to withhold directly from distributions. 5 failure patterns, and I see all of them every season. Forecasting the current year when the prior year number was sitting right there. Missing the 110% bump after a good year pushed adjusted gross income over the threshold. Paying the whole thing in December and assuming that settles it. Forgetting that New Jersey runs its own estimated tax regime with its own dates. And the most common one of all, assuming a big refund last year means nothing is owed this year. If you're watching this in September and you haven't made a payment yet, you're 2 installments behind, but the situation is very fixable. Recalculate the target from last year's return. Then front-load withholding on whatever pay or distributions remain, because that money back dates to April. Make the September 15th installment on time so interest stops accruing on that period. And if your income genuinely arrived late in the year, the annualized method on Form 2210 may cut the charge substantially. 3 things to carry away. First, you get to pick whichever safe harbor number is smaller, and for anyone with rising or unpredictable income that will almost always be the prior year test. Second, withholding is treated as paid evenly across the year regardless of when it happened, which makes it the one tool that can fix a shortfall after the fact. Third, hitting the safe harbor doesn't reduce your tax, it removes the interest charge. If you'd rather not do this arithmetic by hand, the estimated tax calculator on our site runs both safe harbor tests and gives you the 4 installment amounts. And if your situation has moving parts, a business, multiple states, a big one-time gain, that's a conversation worth having before the next due date rather than after it. Call 908-955-0696, or find us at suryapodea.com. We're an enrolled agent practice in Hillsborough, New Jersey, and we do this every day.